Okay, so what are you saying, people, and welcome back to your favorite YouTube channel. So today, guys, we'll be talking about risk management strategy. I'll be going through the 7 key crucial pillars of a risk management strategy in detail, and by the end of the video you guys know exactly what you're doing in the market. So let's just get straight into it. So as you can see, number 1, first step, foundation of the strategy, percentage risk of capital per trade, in brackets no more than 3%. So you want to know before coming into the markets how much you're risking per trade, and this is something you need to be consistent with to build up your risk management strategy. In brackets I've got no more than 3%, because any more than that, especially after a losing streak, and again, no trader is safe from that. Losing streaks happen to everyone. When you do counter your losing streak and you're risking 4-5% per trade, you could be looking at 20, 25, 30% drawdown. And that can, although you can recover that amount of drawdown, but psychologically, that could finish you, and it could spiral out of control and create something even worse as well. So no more than 3%, but again, it's up to you. If you're a beginner just starting out, maybe you want to risk 0.5%, 1%, even less if you're not really comfortable, and then you can slowly increment a little bit more, 1%, 2%. And also, if you do take a lot of trades, you do want to, on average, lower your risk, because more trades leaves more exposure to your account in general. So percentage risk of capital, 1, 2, 3%. If you're just starting out, choose the lower percentages, 0.5, 0.25, even 1%. If you've got a bit more experience, you can push up a little bit, 1, 2, maybe even 3%. Number 2, percentage risk per day, week, and month. Now this is slightly different from percentage risk of capital per trade, number 1. This is now talking about how much exposure, how much do we want to, lose maximum per day, per week, per month. Now, a good rule to have is just having 1% risk or 2% risk per day. So if you take one trade, and you're risking 1%, let's say, for example, then for that day, maximum loss, 1%. This means you only take one trade per day. So if it's a winner, it's a winner. If it's a loser, it's a loser. Break even doesn't really matter, but you just have one bullet in the chamber, fire it, and then we move on to the next day. Learn from your mistakes. If you made a mistake, what you did good, what you did bad at the end of the day, then we go again tomorrow. This will help with revenge trading, fear of missing out, because it means that you're no longer trying to get back involved and recover any losses, or get too greedy and trying to make more profit when really you should be backing down and stepping away. So percentage risk per day, per week, per month. For me, 1% risk per day is very, very good. You can be consistent with that. Per week, you can be looking at 3, 4, max 5% per week. So again, when you hit this 3, 4, 5%, you just want to stop for the week, and then you go again next week. And per month, you want to be looking around 10, 11, 12% drawdown per month. No more than that. 20, 30% per month gives yourself a lot of exposure. So I would say 10, 12 is a good amount to be looking at. Number 3, maximum trades per day, per week, per month. So this is the max. Whatever happens, no more trades than this. So this is a good example, because it's all well good, risking 1% per trade. But if you're going to take 100 trades in a week, 100 trades in a day, you're giving yourself a lot of exposure. And obviously the chance of you losing 100 trades in a row is very, very slim, probably impossible. You probably accidentally will win a trade. But you're giving yourself, your capital, all exposure. Potentially you could lose everything in one day or 1 week if you do take 100 trades at 1% risk. So you want to stagger that over a period of time, and to make sure that you don't, take over excessive amount of trades, and don't overtrade. You want to give yourself a maximum per trade, a maximum day, maximum trade per day or per week, per month. So if you're going to take 1 trade a day, that's the max 1 trade a day, of course. 5 a week, Monday, Tuesday, Wednesday, Thursday, Friday, and 20 per month. 5 trading days in a week times 4, 20. So 1 max trade a day, 5 per week, 20 per month is a good frame to have. Obviously, depending on styles, if you're a bit more relaxed, you might only take a couple of trades a week. If you're a bit more aggressive, you might take 2 or 3 a day, or even more. So again, it's about your style. Whatever style you have, you can tailor all of this to your style, and only that you would have knowledge of. So do take that with a pinch of salt. But yeah, you need to have a maximum trade per day, per week, per month implemented. Number 4, what will your risk to reward be? Either 1 to 2, 1 to 3, 1 to 4. But just a general rule of thumb, you want your reward to be greater than your risk. So even if your win rate slips below 50%, so you lose more trades than you win, your reward can still act as a safety net and keep you afloat. Typically speaking, 1 to 2, 1 to 3, 1 to 4 is a very, very good amount of risk to reward. It's achievable. It's not too big. It's not too small. And if you're consistently taking these trades, obviously your risk should be outweighed by the rewards you're getting. Some people have crazy risk rewards, 1 to 20, 100, 200, you name it. I suppose, if you win those trades, it will definitely cover up your losses and a lot more. But again, it's up to you what you want to have, but you want to make sure that you can achieve it on a consistent basis. So 1 to 2, 1 to 3, 1 to 4, you can achieve that consistently. 1% risk, potentially make 2, 3, 4%. That is good, sustainable, good risk reward. Number 5, expected win rate. Now, win rate is a little bit here or there, but you want to know what win rate you should be targeting over, say, 50 trades, which could be 2 or 3 months, a quarter, maybe half a year, obviously depending on your style. But you want to know what type of ballpark you're working with. Are you working with 80% win rate? Are you working with a 50, 60% win rate? Are you working with a 20, 30% win rate? Because any win rate you can be profitable with. It just depends on your risk to reward. If you have high risk to reward, you can afford to have a very, very low win rate. If you have a very, very low risk to reward, you need to have a high win rate. So it goes hand in hand. But you want to know what your win rate is on average from back testing. So when you come into the live markets, you can see if you're underperforming a lot or you're overperforming or you're doing just about right. So you can tell if you're on track. If you're back testing and you're getting 70% win rate, but in live you're getting only 40%, you can see there's a big gap there. Something is going wrong. You need to go and recheck something if that's the case. And also vice versa, if you're doing much better as well, something is wrong, but it's right. So you need to go and check that out as well. But expected win rate, want to have a nice ballpark around 10% either which way, because you could have a bad month, it might slip 10% down. Could have a good month, it might slip 10% up. So give yourself a buffer room around 10% or 5%. Stop loss size. Now this one is important, but it's also important to know what your style is as well. Because for me, for example, I don't have a predetermined exact stop loss for each trade. The way I calculate my stop loss is just based on candlesticks and where I need to place my stop loss to make sure the trade is safe. Sometimes it could be 25 pips, sometimes it has to be 50, 75, sometimes even 100. And I use number 7, which is position sizing, calculator, which I'll show you guys in a second, to make sure that I'm always risking the same percentage per trade. But some traders will have a set stop loss. No matter what trade they take, it has to be, say, 20 pips, no more, no greater. So if you have a set stop loss, that's good, because then coming into the trade, you can already calculate your position size. So whatever trade you're taking, you're going to be using the same position size for that. But if you do have different stop loss sizes, you're going to have to keep calculating, which is what I do. But for me personally, it doesn't really matter. Just 5 minutes before you're about to take the trade, calculate your stop loss size. I'll show you guys the calculator that I use in a second. And yeah, just take the trade off that. So it's completely preference, but you need to know if you're going to have a varying stop loss or you're going to have a consistent stop loss. And number 7, like I said, position sizing. So I'm going to quickly go onto pip calculator and show you what calculator I use. But if you have a consistent stop loss size, you want to have a consistent position size as well. How many lots you're taking, you want to have that consistent as well if you have a consistent stop loss size. But if you don't and it changes a lot, I'll show you this pip calculator and we can calculate it together. Okay guys, so as you can see, I've got trusty Google search here with Forex time pip calculator there written out. So that's the pip calculator tool that I use, Forex time FXTM pip calculator. And basically to find that, guys, just type in Forex time pip calculator on Google. Basically it's the first option, pip calculator there, FXTM, and it'll take you to this exact page. So this is the calculator. And as you can see, We've got pip amount at the top, so that'll be for our stop loss size, so not for the target. You can use it for the target as well if you want to, but for our stop loss size here, we'll put whatever pip our stop loss is. Then we've got the currency pair, so whatever pair you're trading. It's got all the major, minor, and it has exotics if you trade exotics, and it's also got gold and silver there as well. And then you can use your trade size here. This is lots, so how many lots you're gonna be using for your trade. And then finally, you've got your currency, which is the currency that you're trading in. It only has euro, pound, and dollar, but pretty much a lot of you will be trading in either euro, pound, or dollars anyway, so you should be fine with that. If not, maybe I can try and find another pip calculator tool that has different currencies. But yeah, this is the one I use pounds, so it's perfect for me. And I know a lot of people probably use dollars as well, or euros, so you should be good with this one. And for this example, we're just going to use dollars since it's the generic currency, if you will. So let's say, for example, we have a 20 pip stop loss size for our trade, and let's say we only want to risk 2% for this trade, and let's say that 2% in monetary value is around $100. So let's say we're only going to risk 2% for this trade, stop loss size 20 pips, which equates to $100. So if you lose this trade, $100 is what we should be losing. So say we change that from 100 to 20, because that's a stop loss size. Say we're going to trade Euro USD, generic pair, and let's say we're going to use a one lot size. So you can see for this, if we're using one lot for this trade, we're going to be losing $200, which is not what you want to be using. This will be 4% risk for our example. So you want to reduce that by half. So obviously, if that's one lot size, we need to be using 0.5 lots for this trade. So if you're risking if you want to risk $100, 2% of our account, we need to be using 0.5 lots for a 20 pip stop loss. Now let's say you change your stop loss size for a different trade because you change your stop loss, but like me, let's say it goes up to 50 pips now. So you need to accustom to this, because if you still use that same 0.5 lots per trade, we're actually going to be losing $250 if this doesn't play out, if this trade doesn't play out according to plan. And if 2% is already $100, then you're risking about 5% to equate to $250. So this is a big jump, and this will kind of skew your trading results if you're going to be inconsistent with how much you're going to be risking per trade. So to fix this, we just need to change our lot size. So for example, 0.5 will give us 250. So if you use 0.2, you can see it's $100. Quick maths, I'm joking, I already calculated that before the video, but 0.2 will give us $100. So we need to reduce our lot size from 0.5 to 0.2 to make sure we're risking the exact same size, because the position size, the lot size is not what we want to be consistent with. It's the percentage / the monetary value is what we want to be consistent with. If you're going to have a consistent stop loss, then yeah, your lot size will be consistent as well. But if your stop loss size is changing, then the thing you want to be consistent with is your percentage risk, or how much money you're risking per trade. The same thing really, but percentage risk is what you're going to be consistent with. So we have to change our lot size to accommodate for that. So if you're just going to be risking 20 pips for every trade, let's say for example, and you want to risk $100, then whatever trade you're taking, you're always going to be slapping on 0.5 lots for your trade. And again, this just goes out generically. Whatever your account size is, you can just obviously change the values for that. But if you're going to have a varying stop loss size, then like me, about 5 minutes before I'm about to place the trade, I'll just fill this out for my stop loss size. Again, it only takes a minute or two max to calculate. So it gives you plenty of time to calculate the trade, the lot size, and slap it on it and get busy. So yeah guys, hopefully you found this useful. Again, I'll leave the link to this in the description down below, so make sure you go check it out if you want to. But again guys, risk management strategy 100% needs to be the foundation of your trading. Then you can slap technicals on top of that, and then you can create a bit of a system for you. But I hope you found this video useful. If you want to see more videos like this, just leave a comment down below, say what topic, what do you want to see from the channel, let me know. Ideas are great. If you haven't done already, subscribe to the channel, hit the bell, leave a like on the video, really help the channel out if you're finding the content useful and entertaining. But yeah, guys, I will catch you all in the next video. But besides from that, have a great day, and I'll see you all in the next one.